Good afternoon, everyone, and welcome to the latest webinar with myself, Paddy Andrews, Director of Private Clients in Dublin and Director of Private Clients in Limerick, Cian Callaghan. Thank you to everyone for taking time out. I assume everyone's on their lunch break today. But today we have a very topical topic to talk about. One of the key goals I feel as financial planners, when we sit down with clients, is around the idea of early retirement and what actions or plans people might take to help them achieve this goal. And we all know pensions are one of the key vehicles that help people do that. So, Cian, you're going to kindly discuss some of the benefits, the pros and cons of pensions, some of the recent changes in legislation over the last 4 or 5 weeks as well, and give some examples and demonstrations of how pensions help clients achieve that goal of early retirement.
Yeah, that's it, Paddy. That's gonna anyone who's been tuning in for our last few videos, the whole theme about this is how do you set yourself up for early retirement? What are the things you need to be doing? And of course, your pensions are, as we're going to show you in a few minutes, absolutely are an essential part of that.
Conscious scheme, maybe we've looking through attendees, different variances in experience in financial services and whether it's as clients or other advisors. So we might just start with some very high level side of things, how pensions work and why they are important when it comes to tax relief and long-term planning for clients.
Yeah, I suppose, Paddy, on this, like, we can make this really complicated. Obviously, our job as financial planners and wealth managers is to remove a lot of the complexity and explain these things in simple terms. And that's what we want to do today. As in, I imagine if you're a layperson watching this or trying to do your own research on pensions, it must be mind-boggling. And it is at times unnecessarily complicated. So I just want to give you like three really basic parts of pensions that you need to know about. The first part is you get tax relief on the way in. When you're putting money into pension, you get tax relief on the way in. If you think about it this way, if you're putting €1,000 into a pension, it only costs you 600 if you're a higher rate taxpayer. Essentially, the government is putting in 400 for you. If we remember back in the days of the SSIAs, which people all loved at the time, you contributed €4, the government contributed one. It was a 25% bonus. People absolutely loved it. It was 25% free money from the government. This actually equates to a 66% bonus. You're putting 600, the government is putting 400 if you're a higher rate taxpayer. So there's a significant tax relief on the way in, particularly if you're a higher rate taxpayer. You do get tax relief as a low rate payer as well, but it does obviously benefit you more. It benefits you more the more tax you pay, the more imperative if it is that you're contributing to a pension. The second part, and this is, I think, the one that's overlooked the most by a lot of financial advisors, by a lot of wealth managers, it's the compounding tax-free growth within the pension pot, effectively for the rest of your life, or as long as you leave the money in a pensions vehicle. So, if you're starting out in your 20s, you could feasibly have money in your pension pot into your 80s, into your 90s. You're talking 5-6 decades of compounding tax-free growth. That's ultimately, I think, the biggest part that we have to focus on. If you put your money into a pension and to leave it in the bank, it's not going to be as effective as if you grow and invest the money and get a return because it compounds tax-free. And then the final part is how you draw down the pension. So you do get a lump sum tax-free at retirement. Some of it can be taxable as well. But, again, we can overcomplicate this one. You can get up to 200 grand tax-free. If you have a pot of money worth 800,000, you take 25% of that as a lump sum, you'll get up to 200k tax-free. You can get more at a rate of 20%. But the balance after you've taken your lump sum, that very importantly just goes to another pension vehicle, another tax-free pot of money that continues to grow and compound tax-free. You only start to pay tax when you make withdrawals from that post-drawdown or post-retirement pension pot. But again, the big emphasis here is the money you put in now can remain in a tax-free environment for decades. And that's vitally important.
Yeah, one of the key things, Cian, as well, particularly maybe with newer clients and they're unsure of pensions, might deal with people in their 30s or 40s, and this isn't really going to be relevant to me for 30, 40 years. But a key one is on death. That we've heard, what happens to me if I'm saving for 20 or 30 years, does this money, do I lose it? Does it pass to my family? So that what happens pensions upon death is a really key query from clients, I feel.
It is, and look, obviously there, depending on the type of pension you're in, there are some variables here. But essentially, while you're contributing to a pension, or while you before you retire or go down your pension pot does go to your estate. If you're in what's called a personal pension or a PRSA, it all goes tax free. There are some complexities if you're in a group pension scheme where there is a limit on how much can go. So I would say, look, the ideal situation is get yourself into a PRSA. In the event of death, all of the money goes to your estate, tax-free, no questions asked. It is slightly different after retirement. You have what's called an approved retirement fund or a vested PRSA. Again, very importantly, your spouse can step into your shoes and take over that fund, and then they can make withdrawals out of that. This all changed, and I think it's probably a fear some people have. Back in the 90s, they might have heard of their parents or even grandparents.
Yeah.
The old way of doing this was you saved up all your life, you turned 65, you handed your money over to an insurance company, and you bought what was called an annuity, basically a guaranteed income for life. But if you died, it died with you. That all changed in the early 2000s. Charlie McCreevy introduced, he was the Minister of Finance at the time, what's called the Approved Retirement Fund. But basically, it just allows you to build your pot, to take a lump sum, and then to keep a pot of money there that you invest that passes to your estate on death as well. So any good financial advisor will make sure that your pensions are set up in a way that it does go to your estate if that's what your objectives are. And it's just getting the right advice and being in the right product at the right time.
And the other key thing as well, Cian, I suppose, because it's such a long-term vehicle, death is one issue. What happens if I was to pass away? And the other one, you mentioned it there, that period of horror stories. I've lost my pension. We're obviously in this game quite a while, and would have been probably starting at the tail end of the crash. The horror stories around pensions. So how do any advisor protect against that? And answer that question. If I invest my money, how do I ensure that I don't lose it in the future?
I suppose, yeah, Paddy, and it's one of the questions that it usually starts with, my friend down the pub told me this story, and you meet a client or you meet a family, and there are horror stories out there.
Yeah.
But very importantly, what we need people to understand first of all is a pension is just a tax efficient vehicle to save and invest for retirement. Like no pension is good or bad. It's what you invested in. So once the money goes in, it's what you do with it. So the pension itself is a great idea. There's no bad pensions per se. It's how you treat the money. So look, the simple answer from a Metis Ireland point of view is once the money's in the pension, we only ever invest in regulated assets. We diversify things. I suppose the question you've asked is like, people, I've lost my pension. Where you're in an appropriately diversified fund that tracks the global stock market, the likelihood of that happening is effectively zero. But yeah, if you put all your money into one share, Anglo-Irish shares are the best example, or AIB shares, back before the crash, people did put all their money into one company, and if that company goes bust, your money is gone. That is a genuine risk.
The investment choice on them, which is, and that's the key thing in terms of understanding the benefits. And I think you've covered it really well, Cian, in terms of the tax relief on the way in, the tax-free growth, the longevity of the pensions, and also just having the correct type of investment that's going to suit you at the different stages of your life. So those conversations are important to have. And conscious of today's title of the webinar and why pensions are key for early retirement. So if we focus on, we kind of covered how pensions will work very quickly, albeit. But in terms of early retirement, it's fair to say, and advisors on the call will be aware of this, one of the key objectives for anyone, families we speak with, is that financial independence. How do I get to the point as soon as possible where I can decide if I want to work or not? And that varies from family to family, and some people are more than happy to work into their 60s, 70s, 80s. But early retirement and having the option of getting there, what role do pensions play?
Well, they're massive, and I look. My view is they're a fundamental building block to any retirement plan, but in particular, any early retirement plan. If you're going to retire early, getting a return is massive, and like it's finding efficiency, saving 1-2%. These make a huge difference between retiring at 55 and retiring at 60. So this is where it comes that the pension is so important. It's the tax efficiency of it. Now, I always say pensions, they're not perfect. They're very, very tax efficient, okay? And I have we have basically drawn this out, mapped this out. It does come down to what's the alternative. If you're not, I don't like pensions, but what else are you going to do? You're going to take your money out of your business. You're going to pay maybe 52% tax and then invest it in a regime where it's subject to tax as well. So I'm just going to share my screen briefly here, Paddy, and
Yeah,
bear with me while we get
you promised everyone attending, Cian, there'll be no slides, but
yeah, and thankfully this is not a slide, no PowerPoint here. Okay, so this
very
is
good.
a cash flow projection we've done. Okay, and what we've looked at is starting in 2025 for 40-year-olds investing for 25 years up to their 65th birthday. The top line here shows taking money out of a business, out of employment, or out of your company if you're a business owner, paying your tax on it, and investing the balance. And in this case, the balance is 25,000 euros. So this is the effect of investing 25,000 euros for 25 years from January onwards. You end up with a pot of 863,000. Very importantly, in order to invest that 25,000 euros, you've had to earn 52,083 euros if we're looking at USC, PSI, and income tax. So you've paid 52% tax on the way out. Now you've invested the money, and every 8 years, the government will tax your investment as if you've taken the money out, even if you haven't touched it. So that's called an imputed distribution. So where do you end up? Like let's say just before age 65, you've 863,000 in your pot. The alternative is you take the money from your company, you put it directly into a pension, or a PRSA might be a good example in this scenario, and that 25,000 grossed up is actually 52,000 you can now invest. You invest that money, it grows and compounds tax-free. So you're not getting any kind of taken off the top along the way. And now, by age 65, you have 2.16 million in your pension. That's actually worked out as a really nice round number, because that's effectively, once you go over that under today's rules, you'd end up paying charge of excess tax. So this gets you right up to the maximum, the most tax efficient kind of pot that you can have. So, Paddy, I think the point comes back to, what are the alternatives? Pensions, are they perfect? No, but they are very tax efficient. If you don't want to invest in a pension, your alternative is you pay all your tax up front, you'll pay tax on all the growth along the way, or you can leave it in a pension, let it grow and compound tax-free, and it's more than double the amount. Yes, there's some tax to pay on the way out, but with a good wealth manager, good financial planners, you will actually be able to manage that tax bill on the way out a lot easier.
Yeah, and I think you touched on it there as well, Cian. One of the challenges for pensions is cost of living around Ireland. I need the money now, and I have a young family, or I'm buying a family home. Obviously, the challenge of house prices and things like that. It's always the balance between, and particularly we see this with business owners, the working capital. I need to keep the money in the business for X, Y, and Z. So it's that balance between finding what do I need in the short term, and unfortunately there's no way around that. You have to pay the tax and spend the money now, because life is for living, obviously, or business is for doing at the time. But that balance in those conversations around, this is my surplus, this is what I can afford to put away, what's the best vehicle for that? And I think you made a pretty good case in terms of the investment growth, the tax relief on the way in, and just the long-term planning around it. So I was always conscious with that balance between short-term, medium-term, and long-term. And that's the benefit, I suppose, of speaking with, any financial planners or advisors to give you a steer on that. But I think it's pretty clear the benefits of pensions for people and for the families in the long run. I said at the top of the webinar, probably the last month, pensions have never got as much airtime. They're a hot topic. I've never seen as many people coming on at lunchtime for a webinar as well. There's been a lot of changes, not all of them brilliant, but some of them have been very positive. You might just touch, Cian, on the impact of the budget, the threshold increase, and last week's news around the finance bill and the impact that is going to have on future funding.
Yeah, Paddy, weird enough to say exciting times in pensions, but when you're a pensions nerd like me, it is, and I'm loving the stuff that's happening right now. There's some good and some bad, but it is great to be going to delve into this stuff and realize, well, we can actually give great advice to the families we work with now as things change, and they're delighted that they have us in their corner as well, because again, trying to navigate all these changes have been quite a lot in the last number of years. is really difficult. There's two big ones that everyone needs to know right now. What has changed substantially? Okay, number one is the pension fund threshold is increasing. So up until right now, and for next year as well, the maximum pension pot you can get is about 2 million euros. Once you go over that, you start paying additional tax. Don't need to go into the details of it, but put it this way, you don't want to go over that number, that pension fund threshold. It's no longer tax efficient. You can get to about 2.15 million before you actually pay any additional tax. But again, that's probably a bit too much detail. What's happening now from the start of 2026, that pension fund threshold will increase by 200,000 euros per annum for 4 years. So it'll go to 2.2, 2.4, 2.6, until it gets to 2.8 million at the start of 2019. So huge.
2029.
Sorry, 2029, Paddy, yeah. So it's a 40% increase in the pension fund threshold. This is something they've had to do because of the rise of inflation over the last 10 years. Yeah. You know, as in people's wealth has been eroded. Absolutely, it is a requirement. Now, there's a couple of very important points to note on this. The pension fund lump sum hasn't changed. You're still getting a maximum of 200,000 tax-free and a maximum of 300,000 at 20%. But again, you can get roughly another 800,000 into your pot, growing and compounding tax-free. And what I would say is to anyone who is coming close to retirement or coming close to even the pension fund threshold, what I would be considering right now is, number one, if you don't need to draw down your pension, if you're at 2 million euros today, if you don't need to draw down your pension, don't. If you have enough money and income from elsewhere, spend that money first. Leave your pension grow and compound until it gets to that 2.8 million figure, provided you know you can wait until 2029. You need to get advice on that. Contact us, get an expert financial planner to look at your situation. The second thing is, if you're at around that 200K mark, you probably now have scope to top up your pension. So just rough numbers, let's say take January 2025, if you're at 2 million euros, if you topped up your pension by 350,000, you'd get to around that 2.8 million figure with a 4% growth rate by 2029. So you do have scope to put more money in, particularly between now and the end of the year, as we're going to touch on in a minute. And the very last thing then is, where you're looking at deferring your pension, you have the pot there, it's built up, get the money into a PRSA now. We touched about this already. The death benefit with the PRSAs, all the money goes tax-free to your estate, no questions asked. So if you're going to basically hold, just make sure it's in a PRSA and you don't have to worry about any kind of potential what happens if I die between now and 2029. The second
other change, Cian, which was in last week's finance bill. Probably not as positive a news, but probably understandable.
No, and not surprising as to why they didn't announce this one in the budget. They left it a week later and kind of put it in subsection in the finance bill. So again, we need to delve through that. We need to read through that. Okay. So let me just give a little bit of background on this first. Up until 2023, for a PRSA, it was kind of hard to get money into it. You were limited to your personal limit. So someone in their 40s could put in 25% of the salary. That was it. That all changed dramatically in 2023, where the finance bill at the time came in and said, if you have a salary, if you're an employee of a company, your employer can make unlimited BIK-free contributions to your PRSA. So if you had a salary of 20,000 euros, your employer can put in 400 grand of an employer contribution. And look, it was certainly in terms of pension simplification, it made things way easier. A question we often get asked, Paddy, is how much can I get into my pension? There was a convoluted way of working it out.
It's a lot more straightforward then.
Now it's like, how much have you got in your company? Like it became as simple as that. And obviously, at the time, we were aware that this was going to lead to people making quite significant pension contributions. The government came under some political pressure, and what they have changed in the finance bill now is to say, from the 1st of January 25, an employer can contribute 100% of an employee's salary to a PRSA.
Yeah.
So we'll take that same example. You have a 20,000 salary. You're a business owner, and you take 20,000 salary from your business. You can put in 20,000 into the PRSA. If you put in more than that, it's basically treated as benefit in kind. You don't want to get into that scenario. So there are some very important points to note on this, and that's first of all, Between now and December 31st, the law of the land is that you can make unlimited BIK free contributions. You need to have a plan for your pension and for your business between now and December 31st. And then you need to have another plan from January onwards how you're going to pension fund. So absolutely, you need to contact us. You need to get expert financial advice if you're thinking about acting on this between now and December 31st. Going forward, there are some there's like pensions. It's not that they're no longer attractive or PRSAs. Like if you're a business owner, salary of 100,000 euros, you can still put 100,000 euros directly into your PRSA. You know, that's still really, really attractive. And there also is master trust we can use for employers who very long service. They can still get significant lump sums into their pension from 25 onwards. But again, this is all about knowing the ins and outs of this. When do you use certain products? At what point in your life? And you have to get expert advice on this. The DIY approach, we've talked early retirement, is hard enough. But when it comes to pensions legislation, just don't do it yourself. Get the advice. Contact us. I said you can get us through our website, set up a meeting, and we can go through the detail of this stuff.
No, Cian, that's spot on. I think, look, we're conscious of people's time on their lunch break as well. We've been on nearly 25 minutes. But the key takeaways, kind of briefly covering how and why pensions work, how attractive they can be in terms of the tax benefits on the way in and the investment returns. Specifically looking at that question of achieving that financial independence as soon as possible, that early retirement, which is a common goal we see across many families we speak with, and the valuable role pensions play in that. And then also the latest raft of changes over the last 3 or 4 weeks. Still time in terms of the unlimited contributions between now and the 31st of December, but probably with the introduction of the Finance Act in 2025, that will be the least are probably one of the last actions, big changes around pensions for the foreseeable future, outside of the infamous auto enrollment, which may or may not come in next year. But
definitely webinar for that one.
Yeah, a series of webinars.
Yeah.
Thanks a million, Cian, for your time. Thanks a million to everyone for joining. If you had to pop out early, or some of your friends or colleagues might find this conversation beneficial, the recording of this webinar will be up on the Metis Ireland YouTube channel in the coming days. Keep an eye out for the Metis Ireland staff LinkedIn pages as well. We'll all be posting links to that page as well. And we will catch up next month, probably after tax deadline, because we've a hell of a lot of work to do between now and the 14th of November. But we'll catch up in November and we'll touch on estate planning, which is another key aspect which we cover for our family. So thanks a million to everyone. Cian, thank you for your time, and hopefully we'll catch up with everyone remotely next month.